We are talking Snowflake briefly today, and then we've had a couple other people reach out about a couple other stocks. Who knows with what we'll get into, though, but I do want to take a quick look and look specifically at Snowflake. They gave some guidance all the way out to fiscal year 29 for them, which is 2028. And I want to see, just based off their current valuation of $58 billion, is the company, even on a fiscal year 2028 perspective, fiscal year 2029 for them, is it overvalued? The answer is yes. But we'll get into the numbers. And Chris, you noted that you did not have the opportunity to look at it, but are you still very bullish about Snowflake compared to Palantir, or what? How are you feeling?
I think Snowflake does better than Palantir long term for now,
Yeah.
but the
Long term or medium term?
Long term. The thing is, look at Snowflake's growth rate. It's still good. Like, still way past Palantir's growth rate, unless it starts to reaccelerate above that 30% mark. You're looking at a bubble-ish stock for Palantir. So just purely based on valuation. So we've got to keep seeing this with Snowflake to see like what their growth rate looks like. The other thing is I'd probably keep my eye on someone like Altimeter Capital with Brad Gertzner, see what some of the changes are with his portfolio allocation, because I think he has more insights on how the company's planning on growing even more going into the future. So if I start to see Brad Gertzner start to sell out of this position, and it's one of his largest position, I'm probably going to take a second look and say, what am I missing here? Because there's so many things about this company that are still like an X factor.
Right.
I think that one of the key differentiators is going to be their venture capital arm. That's not necessarily like recorded in the current valuation model, but we'll see.
Yeah, I think we'll get a little bit into how the revenue has been slowing, but I think that's just the rule over large numbers, right? But even still, I'm curious to see what your thoughts are, because it is slowing down. It's not as slow as Palantir, so I'm just going to throw that right out there. But in terms of what they're forecasting over the next 5 years, it's kind of surprising. So I kind of want to get your thoughts into it. So let's top into some of the numbers. So keep in mind that this particular quarter that they're reporting is their Q3 for fiscal year 2024. So they're a little bit strange, kind of like Microsoft, how they're in the 2024 range. So these guys, for fiscal year 21, 22, and 23, they had revenues of 592, 1.2 billion, 2.1 billion. And now they're kind of on pace for 2.65 billion in the fiscal year 2025 quarter. The run rate at the moment is about 750 million per quarter. So it's pretty significantly ahead of, say, Palantir. Palantir's fiscal year 2023, so the same year that we're kind of reporting against Snowflake, is looking to be about 2.1 to 2.2 billion. So overall, you're looking at about 20% more revenue coming from a Snowflake in this particular year than we are for Palantir, and the growth rate is about double, right? So this particular quarter here, looking last year in Q3 of 2022, or they're calling it Q3 of fiscal year 23, they're seeing a 32% revenue growth from 557 million to 734 million. This is all just, jumbly gook, and, does it actually matter? Let's get a little bit deeper into some of these numbers. They're almost 9,000 total customers. Their Forbes 2000 customers have kind of flatlined. They're still at about 30% of all Forbes 2000. So there's that. Their customers with over $1 million of product revenue has grown by 50% year over year. Net dollar retention is slowly on a decline, but much better than Palantir, 135% rather than the 109% that Palantir just provided in the most recent quarter. And their gross product margins are increasing as well. They're up to 78%, but still below what we have for Palantir, which is like 81 to 82%. Non-GAAP adjusted free cash flow is at 15. Palantir is in the 20s, so they are kind of behind in terms of comparing that to Palantir. And their focus on cash flow generation is also slightly behind Palantir. But But I think from a cash flow from operations perspective, I think Snowflake might be winning. I think it's just the fact that Palantir has so much cash on hand, and they're generating a decent amount of treasury income, that might be why they're slightly ahead. But they're kind of neck and neck overall with the cash flow generation there. And they have quite a few more employees, 6.5, almost 7,000 employees there. The things that I wanted to get into are kind of here. So the year-over-year product revenue growth was just a few years ago 120%, 106%, 70% last year. And from last year to this year, they're going to be about 37%. So they are slowing down, but that might be the rule of large numbers, just the fact that you're getting larger and larger in terms.
I think it's more important to look at the operating income. That's the thing that always interests me. If your operating income's growing, that means that you're getting more value from your shareholders. So
yeah,
the fact that they're able to monetize at a higher rate, that's good. So go ahead. Sorry.
So no, that's a really good piece in there. So they're forecasting about 7% ops margin. So off of this, they're kind of expecting, what is that? I'm not very good with math. You guys know that. 2650 times 0.07. So expecting about 185, 200 million in terms of ops margin that they're going to be kind of creating from the company. And now, of course, when you look at it on a GAAP basis, this is something I'm going to dive into because these guys are giving out 3 times as much share-based compensation as Palantir, and we already know how bad of a problem Palantir has. So on a GAAP basis, these guys are still largely unprofitable. But that could be, always kind of going back to the fact of, well, what does it really matter, right? If you're building cash in the company, that might be more important than, being a GAAP profitable business. But anyway, just some food for thought there. And then adjusted free cash flow on a non-GAAP basis is about 27%. So this is for this year. So they're a quarter away. So they need to kind of generate another $750, $800 million to hit this target and get to this kind of 7% non-GAAP operating margin. But the thing that really triggered me to start doing some math was this $10 billion approximate fiscal year 2024 target. Now that's
2029.
Sorry. Thank you. The 2029 fiscal year target, which is our 2028, their 2029. So 5 years down the road. So my thought process is what compound annual growth rate do you need to be able to go from 2.6, 2.7 billion to 10 billion in a matter of 5 years? And the answer is 30.5%. So my thought with that was, well, you're already slowing down this year to 37%. What kind of reacceleration are we expecting when we get into next year for this to continue at that pace? Because I doubt going from 2027 to 2028, they're going to continue to see 30%. That'd be pretty impressive. So I anticipate that they're in forecasting they're going to get back to 45, 50% revenue growth rate next year, and then possibly slow down from there to be able to hit that $10 billion target. But another piece that I wanted to look at is the non-GAAP. So this is before share-based compensation, 25% non-GAAP operating margin. And then the adjusted free cash of 30%. So let's just break this down. $10 billion in revenue, that's about $2.5 billion in non-GAAP operating margin that you're getting. And then about $3 billion in adjusted free cash flow. That's before share-based compensation. Now, hopping into this a little bit with some of these numbers, this is where it gets a little tricky, so I apologize. Let's just see. Where is all share-based compensation? Okay. Sales, marketing. That's just them. This is them. Okay, so here's all share-based compensation for the entirety of the company. It's about $300 million per quarter that we've kind of observed over the past 4 quarters. So you could say it's anywhere between 250 to 300. It looks like, just based off the fact that the company's grown a little bit in the past few quarters, that it's hovering around 300. So let's just say it's 1.1 to 1.2 billion dollars in impact on an annual basis for now. So if you look at this, go back to this graphic here. Are you following me, Chris, or am I just talking a lot of numbers?
I'm following. Okay. I'm following.
Okay. $10 billion top line, right? 25% operating margin. So you're walking away with $2.5 billion in operating profit, right? Take $1.2 billion away from that, and that's going to be your GAAP operating margin, basically, of, I would say, about 12 to 13%, because you're taking about 1.2 to 1.3 billion away in terms of share-based compensation. So if you're thinking about that, you're left with about, let's just call it even 1.5 billion in operating profit. The company's $58 billion today. You're looking at, just based off of that, 58 billion divided by, let's just say you're left with 1.5 billion in operating profit. Looking at a price to earnings, or price to ops profit, I guess, EBITDA, whatever you want to call it, of 38 times. Not in today's guidance, not for fiscal year 24. What we're looking at for this year, 2.6 billion in revenue, 7% operating margin on a non-GAAP basis, 27% adjusted free cash flow margin. You're talking about 5 years down the road, after an annualized 30% compound annual growth rate, and you're still looking at a 38x in terms of ops profit. To me, this company is very, very overpriced. I don't know if I'm just throwing smoke or if I'm trying to put mirrors up for you, Chris, but I'm really curious, does that make a lot of sense?
I wouldn't buy it. I wouldn't buy it at this price. No, I'd probably hold back. There's going to be other parts of this target that are going to be revealed, I think, over the next few years. So yeah, I think right now buying it today, you might be a little bit overvalued, like paying a lot. It doesn't even fit the rule of 40 right now because of all the slowdown that it has. So in my opinion right now, I just wouldn't be as enticed by their guidance. But then again, there's other parts to this business that we may be missing. So we probably have to do a little bit bigger of a deep dive. I hate relying on just these numbers. I'd rather speak to people within the industry to see, okay, like what kind of other products are they likely to upsell? What are some of the things that they could integrate into their business model that they could utilize to, grow their business and then grow their side businesses? Mm-hmm. And then also, they are running a venture capital firm on their balance sheet, which could pose a lot of synergistic benefits later on. So, let's take a step back from just looking at the guided numbers and see, like, okay, what's the true valuation on this company, and like what are some of the intangibles that we're not seeing? Because I'm seeing a lot of big time Wall Street people in this company, and the fact that they're remaining in this company leads me to believe that there's something there that we may actually be missing. So we're looking at the raw numbers, but let's like I said, let's look for some intangibles that we may.
So do you think Slootman is sandbagging? He has to be, if that's kind of what you're saying there, right?
I wouldn't say sandbagging. I just say that he's painting a target that it's something that you can easily meet, but he's not exactly putting out some of the other things that may be out there. Remember, there's also acquisitions that the company has made that they could readjust a lot of their calculations on in the future. So I'd say this is good to take a look at it in just terms of, like guidance, but there's X factors in there. And I feel like it's a disservice to do guidance this far out.
Yeah.
In my opinion, because you don't know what the world is going to look like. You don't know what the technology landscape is going to look like. It's nice that a CEO wants to give this kind of transparency, but I don't know. I'd take a second look.
Well, where I would say, thank you for the $5.99 super chat. That's much appreciated, Pisash. What I would say though is, I'm doing it a service by even having this conversation because I haven't even listened to the conference call. And
Exactly.
there
I'd
could be
say,
some
yeah.
great insights, but the thing that confuses me is the call that I heard in 2Q is not what showed up, which obviously is why the price rallied after hours. I
Yeah.
think that they were still painting some sort of dismal kind of rest of the year, and they ended up, beating that expectation because they're up, 7.5% after hours, up to $188 per share, $58 billion market cap. So my question, I guess, is
Let's do more research before we
yeah,
talk about it. Let's do more research. That's
yeah.
it. Because if it's nice that we want to comment on it, but unless we hear the conference call, we understand what's going on. We see some intangibles. Like I said, all we're doing is just talking about the general numbers, and I don't think it's going to help.
Yeah.
So.
So I mean, what I do want to hear about though is I mean, obviously Palantir is a competitor. That's obviously overpriced as well. What are your thoughts on other competitors in this space?
A lot have been rallying pretty hard. It's nice to see because it's a wake up call to a lot of people that are in the SaaS business, because they're just so important to the general functioning of Silicon Valley. You kind of want to see that, but I feel like we are hitting points where right now valuations are starting to get a little bit stretched again. But let's answer that super chat.